Good morning, traders. This is Ken Calhoun, daytradinguniversity.com, and in this video lesson I'm going to be teaching you how I set entry triggers for gap stocks and how you can identify what the next sequential entries are, say the first entry, the second entry, as well as how to go in the direction of the gap as well as fading the gap. And there's a number of different things that we want to look at. The first thing that I'd like to identify is the magnitude of the gap. Let's take a look here at an example. And fortunately on this morning, today, February 22nd, 2006, we've got plenty of great gap stocks to work with. That's not always going to be the case. First question that people ask me and have for many years is, where do you find gap stocks? Is there a scanner that you use? And no, I simply look at the CNBC, the financial news television, the cable news each morning, and it will tell you which stocks are gapping. Of those, I like to see stocks that are priced at least 20, 30 bucks a share for the most part and gapping at least 2 points. Now let's go through step by step how to set entry triggers. That's the most important thing. Here's example BIDU. BIDU, you can see that this is a 2-day chart. This is the previous day. It's what I always use for intraday trading. 2-day 1-minute candlestick chart. 2-day meaning today and the one immediate past previous trading session, which is yesterday. And you can see the stock is gapped up 10 points. Right? Now we don't care why. All we care is how can we make some money on a trade on this. First of all, let's set our long trigger. What would we look at? Well, the stock is gapped up to 62. The previous, I'm going to say the pre-market low. Okay, that's why you need to have charts that show you what's gone on from, and start the time to show from 8 o'clock. And you can do that, at least in e-signal, just chart times open time at 8 and close 6. Put at 8 a.m. Eastern time so you can see number of days too, and these are some of the other settings. Anyway, so having done that, you can now see where everything's trading. How would you set the entry trigger for this? High is about what? 62 and 3/8, 62.4. My entry would not be right over the previous high because that's an obvious place at which you might get stopped out, or market makers might run to test resistance, sucker some traders who buy the first breakout and then step on the ask and watch it plummet back down into the range. So I would use on this one 63.3. I would want the stock to clear the this will be 63, this line. I want it to clear this before going long. So 63.3, my long entry would be here. For setting short entries, okay, for gap up stock, I always make it lose the pre-market opening gap support. And in this case, that's 60, which works out great because I like to short under decade or multiple of 10 values. So the short trigger on this would be 59.4. Okay, and this is a live market. You know, this is going on in the live market here. We'll see where it goes. 59.4 for a short, 63.3 for the long. Okay, that's how I would set that. Do you see what I'm doing here? Now, one of the things how would you set the next trigger? Let's say the stock starts to plummet down short, and for whatever reason you don't pull the trigger at 59.4, and it continues to drop. Where would you set the next short? Well, I would use just the loss of that next whole number. So say 58.7 would be my next short trigger. Okay, and so forth. One thing that I noticed too that I teach people is that we like to use the 50% range or Fibonacci as kind of intermediate support for this. So my trade potential on either of those entries would only be at about 57. At this point, I would expect if the stock were to drop, it would chop around and go sideways here a bit, and so this would be a dangerous place to be in the stock at about the 50% range of that gap. Get it? Let's take a look at a few other examples here. I'm going to go through these quickly. Here's a gap down today. AXCA stock closed yesterday at 16.5, opened up at 11.5. Yeah, we don't care why. Fight the temptation to go look at what news caused that, because it would unduly bias you as a trader. Where would the earliest long trigger be? 12 is the nearest whole number support, and about 10.75 as the nearest, or 12 as resistance, 10.75 as support. Where would you trade this? Personally, on bounce trades or so forth, I'm much more skeptical, much less likely to want to enter this at all. The earliest I would look at would be if it breaks 12.5, and I would use 12.6 as my entry trigger for this. And again, remember, we only expect, and I'm just eyeballing it here, but about 50% of that gap range would be the max trade potential. So if I were to enter 12.6 long, I would expect to work out, say, half of my position as it gets near the 13, and then the other half as it reaches somewhere near 13.5, right? Now here's an important point for, and let's say before I get into that, which is a volume point, the better trade is always in the direction of the gap. So I'd like to see the stock move up here, run out of gas, start to come down, and go short at, say, 10.5 or 10.7 or so would be the earliest I would short this stock. I'd prefer to see it lose the 10 and say 9.7, 9.8 would be a second short trigger in this stock. Okay, so in the direction of the gap. The previous one, Baidu, that means, for example, I would go twice as many shares in the direction of the gap as I would on a gap fade. And in AXCA, for example, if I were to, say, do 300 shares long at 12.6 for if it were to bounce here, I'd go, say, I don't know, 500, 600, maybe 700 shares on a short at 10.5, another 500 at 9.7 if it were to continue in that direction. Okay, let's take a look at a couple of other examples here. NTRI, the volume's not quite as good on this one, but how would you trade this gap? Well, the first thing is to draw the immediate support and resistance. Support at 42, resistance at 43, that works out fine. Set the entry. For stocks that are priced over 30 bucks a share, I usually give it at least a half a point, what I call a safety buffer, or a place at which I would avoid any chop and churn. Because if it comes back up here, I don't want to get in long at the first sign of a breakout over 43. I would use, say, 43.6, 43.7 as my long trigger, and that would be the preferred direction of the trade for NTRI. Where would I go short? Just a loss of the 42, right? And again, 41.7, 41.8, depending on what kind of volume we see in time and sales. Remember, too, as these stocks move, always look at your time and sales pattern and see exactly, how fast it's moving as it takes out support or as it takes out resistance. And we want to see high volume and high volatility, high speed in the tape as it moves. Let's take a look at another example here. GRMN. This one I don't particularly like. This would be an example of a thin, I had some trades printing here along the way up. It's faded back down. This would be a dangerous stock, and I would likely not trade this one at all. Okay, why not? Well, it doesn't have a nice, clean, well-defined pattern, right? There's a lot of chopping, let's say, thin trading here, and the volume's under 20K per minute, as you could see in the chart. If you take a look at, for example, Baidu, you can see that although the volume's not up, again, over 20K per minute, at least it has a nice, well-defined kind of a bear cup here with resistance at 62. This other one, GRMN, very thinly traded stock, and it would be very dangerous. Experienced traders only, I would look for a move, preferably long over 75, say 75.7 later in the session. Would I go short here? Possibly, if it were to form some kind of a base or consolidation here near the 72 and then start to roll over, then I would go short at, say, 71.5 and expect to cover it by 70, which again is about 50% of that gap range that the stock is traded, and is also a multiple of 10 likely support region. Okay, always map out visually for yourself where the trade is or where you expect the trade to be, and if it doesn't follow what you expect it to do, then don't trade it, right? And this would be an example of one I would be least likely to trade. Those are all previous examples here. Baidu, NTRI, AXCI are all exterior, the best gaps. Frequently you'll see Google do, and other stocks with wide ranges, will frequently have what I call an interior gap. And Google always has interior gaps. I've not seen a trading day yet where it opens up exactly at its previous day's close. It always gaps, usually into its range. How do you trade this? Well, previous day's range is what, 373.5 down to 365. Trading range this morning is all the way in here. I don't see a good trade here, at least not short. Best trade would be, and again you see some resistance here, how would I trade Google this morning? I wouldn't. Yeah, this is an interior gap without a clearly defined pattern. It may recover here and get back over 370, but because that's near the previous day's high or testing in that upper third region of the previous day's high, I would be unlikely to trade this. Earliest long that I would look at, if, for example, we see the market rally and we get a lot of volume and so forth, and the stock is starting to get buyers, 370.7 would be my earliest long. And earliest short here would be a loss of the 368 at, say, 367.7. But those would both be, say, if I were to give it a grade, a C or D level trade, they would be very risky, and I would only do, say, I don't know, 100-200 shares at most on that, because it's not a very well-defined pattern, right? I don't have enough to work with. Something like this, I'd be much more to trade multiple times. So, to summarize here, one of the things that I want you to look for in your entries is how to set the first, second, and third entry trigger. First thing you would do here on a short of, say, loss of a 60 would be 59.7. If you have reason for doubt, say 59.4 would be another breakdown point. Next would just be each successive loss of the whole number until it starts to get near the 50% range of this gap, which in this case is around 57. So I would look to not trade it to the short side much more under 57 if we are able to get a couple of shorts off here. For long, up over, say, 63.3, as I said. Where would the next trigger be? Well, same thing. I just use sequential whole number breakout. So I do, say, 64.3. If I don't see, and this is one of the points I was going to make earlier, if I don't see increasing volume or an increasingly volatile tape at the time of the entry, I will hold off and, say, make it break out over the next whole number. And again, you want to always combine what's going on in the chart with your time and sales pattern so that you can see a strong breakout as the stock is moving in your direction for a gap. Anyway, hope that's helped. Go back and scrub back through this video and take a second look at some of the things I've said. What I want you to learn is, first of all, how to get out of stocks as they retrace near the 50% line if you're fading a gap. The better of the trades are always, this is the number one point that I'm going to make here, is your trades are always better in the direction of the gap, or as my colleague Steve Nissen would say, a window, a Japanese candle chart technology. You want to be able to go in the direction of the gap for most, or I like to go in the direction of the gap, so this means a long continuation, because the street has voted, and they have voted to buy, so that doesn't mean it's overbought and you should automatically try to fade it. The better trade potential would be to the long side. However, we're also ready to go short if it drops, right? Avoid trading, last point, avoid trading inside the gap, the pre-market gap range. You don't trade inside that area, right? That support resistance. You wait for it to break clear of that, because otherwise you're likely to see it chop and churn around inside here. So anyway, best wishes for success. This is Ken Calhoun, Day Trading University, with how to trade gap entries and how to set the entries for gap stocks, both long and short. Best wishes for success.